been in one of these overview and research ideas sessions, the idea is Alon's not just presenting one paper. He's going to present kind of an overview of the field, highlighting unanswered questions and research topics, but also offering a lot of opportunity for you to ask questions throughout. So it's kind of like a seminar of a review paper session. So with that, let me turn it over to Alon.
Thank you, John. All right, so I want to thank John for giving me the opportunity to talk about research that we've been doing over the last 10, 12 years or so. This is kind of a long title, and so I'll try to explain shortly why activism and hedge funds are somehow related to influence and persuasion. We'll see that in a minute. Most of this work is going to be based on work with several authors, mainly Wei Zhang, but other individuals who would work with, and I'm going to cite these works as we go along. But one of the things that I'm going to try to do today is, so I begin with work that I'm more familiar with, which is of mine, and that will transition over time, and certainly towards the latter part of the presentation today. I'll try to actually emphasize the work of many other teams that have asked really different and interesting questions, that are currently working on different questions. And that'll be towards the last 10, 20 minutes of this talk. I'll try to give you a sense of where the literature is going with quite a few different teams that are asking interesting questions. So we'll start with my work, and as I said, the focus here is on hedge funds engaging with corporations, trying to alter all sorts of firm policies. And unlike what we've seen, say, in the 80s, where you're trying to try to go for majority, here the key aspect of activism is that typically the stake size you're going to acquire in the entity that you want to engage with is going to be low, on the order of 6%. You're going to see that in a minute. So the reason for the titles, the reason for the way to think about where I'm heading is that the only way for me to bring about change is that I need to influence, I need to convince all the other shareholders that my plan is the right plan. Okay, that's the way to think about hedge fund activism, unlike what we've seen, say, in the early 80s. And so I have one slide just to kind of, which I'd like to put up because it gives you a sense of a background of how, where hedge fund activism, one way to think about a starting point. And the starting point is work, clearly there's been a lot of work on institutional shareholder activism, pension funds, mutual funds. And we've had that published in the 90s, several pieces of work. And when Bernie Black, for example, surveyed the literature on institutional shareholder activism at the time, Bernie was one of the early people that sort of argued that perhaps institutions that have a large enough stake in the company will be able to get around the free rider problem, shareholder passivity, and yet, when he surveyed the literature, what he finds is that the best, this is working on that. The best reading of current available evidence is that institutional investor activism does not affect firm performance. And then Laura Starks is still giving sort of a broad review of the literature within sort of 9 years afterwards. The conclusion is roughly the same. When you look at CalPERS, when you look at other sort of institutions of that kind, not hedge funds, and you ask what is the impact, the empirical evidence of shareholder activism is that we don't see improvement in multi-operating or stock market performance of the public companies. Now, of course, there's been a lot of literature since then to try to understand why is it that we're not seeing these corporations being affected the way we anticipated. And I quoted here Ed Rock's recent paper that sort of surveys and summarizes all sorts of conflicts, incentives that are misaligned, that have been sort of proposed for why these earlier institutions, these different organizational forms, have not been able to engage with the company and bring about change. And yet, when you look at hedge funds, right? There are clearly significant differences when you look at a hedge fund versus a pension fund or a mutual fund, right? So you can think of the steep incentive compensation of a hedge fund manager. The fact that there are fewer conflicts of interest. I don't want to manage your money as a corporation. If possible, I can use leverage. If I want to, I can lock you up. Okay? I can go completely undiversified if I want to, which a mutual fund manager cannot do. So if you look at Bill Ackman's portfolio at any given point in time, he may have less than 10 stocks that he owns. He can put 1 or 2 billion in any one and tilt as much of his portfolio in any one of these companies, something that reserve institutions could not do. So when you combine flexibility, big stake size, the ability to use leverage, we're going to look whether that in fact takes place, all of these suggest maybe we will see different outcomes. Whether the outcome is good or bad, that's where the literature initially put a lot of emphasis. What happens when we see a hedge fund being paired with a corporation? What do we see subsequent to that? And that's where I'll spend the initial part of the talk today. And so, before looking at the data, again, this is part of the background. What you see here in bars, this is the time series of activism events, the way we've defined them in earlier work. Again, I'm going to be a bit more specific how this data is collected, by the way we've shared it with financial economists over the last decade. If you're interested in that data, or to work with that data, we've shared it. So what you see here is that hedge fund activism, this is in the mid-90s, clearly there's an upward trend. We've had in 2015, about 400 to 500 events in the US. There's clearly an upward trend. You see some evidence of pro-cyclicality about this trend. But what's interesting is we have a trend of more institutional, of hedge funds, hedge fund activism becoming more prominent. What I've also drawn in pink is the median stake size within any one of these years. Right? So what you can do, for example, you go to 2014, you look at these, close to 200 events, and you say, what is the median stake when the activists first engaged with the corporation? Right? And I trace that over this roughly close to 20-year period. And you see that's holding steady. It's slightly less than 7%. Okay? This kind of echoes what I said before. You're not looking for outright control. You hold about 6 to 7%, and then the issue is how do you convince management? Well, it's the other guys. And when we know who are these other guys that are going to be prominent, we know that over the same time period, passive institutional ownership has trended up. It's the BlackRocks, the State Street, the Vanguards, the Fidelities that have basically, if you open any one of these 13F and you ask who owns any one of these US corporations, it's BlackRock. When you add them up, you easily come up to 20, 30% like that. And so the way to think about this graph is that activism is becoming more and more prominent. At the same time, the passive institution owners are becoming more and more prominent in ownership of US corporations. But if I own 6% throughout, and these guys are becoming more important, I got to make a good job in persuading them that my agenda is the right agenda. That's why my title is about persuasion. Okay? You just cannot win otherwise. And I come back to Ed Walk's paper, and I'd like to read it because I think it sort of nicely summarizes what I just said. Institutional investors are now willing to support hedge funds and other corporate governance activists when they're convinced that doing so will increase firm value. As one hedge fund manager explains, the brute force of ownership is not required anymore because the big institutional players listen to both sides and are willing to back the activist fund if they believe in them. You can win with persuasion and ideas. And this is what it's all about. Okay? And I want to show, of course, that what is the empirical evidence? But at the end of the day, you want to think about this as not being something coercive. You're going to put up your white paper, you're going to try to do your best to convince these other institutions. And that's how, that's what's going to be proved whether you're successful. So I want to put one slide up in a minute before we're going to jump into evidence and current research. This data, where's it coming from? In the US, when you have crossed the 5% threshold, you have 10 days from the point at which you cross that threshold to file with the SEC and say, here I am. I own perhaps, by 10 days later, you might have 6% of the firm. You can state in that Schedule 13D filing that you made, what is it that you want to do vis-a-vis the company? You may not have to, but then you can leave it blank. But if you want, you can say, I want to talk with them about payout, I want to talk with them about the strategic issues. And we collect all that information. And as I said, what the ownership is, and as I'll mention these other issues, cost of purchase, these filings are incredibly unique in that one of the things that the law dictates of the activists is that you have to report how you traded 60 days leading up to the filing. Right? So I know how a reformed blockholder traded, how many shares they were sold, what price, leading up to the event. And you'll see that some researchers have used that in their work, which I'll describe later. So you try to collect these filings, and then many of them, because a lot of entities and not necessarily hedge funds file 13 of these. You try to focus only on hedge fund-driven events. Now, of course, there are cases when the target is large that the activist doesn't have enough capital to cross the 5% threshold. Microsoft, Apple, DuPont. And so you want to be able to get those events in that sample as well. So we try to do new searches to add them into the sample that I showed you in the previous slide. Okay, and that's the sample that we'll be sharing. And again, filter out all these other entities that file Schedule 13B. And I'm going to skip that, but effectively we're going to look at these events. Not only from the point of entry, anytime you've filed a Schedule 13D, and now if you've changed your ownership, typically think of it as 1% or more, you have to file an amendment within 2 days. So I can trace your ownership over time until you've fallen below 5%. So I can also have a sense of how long did you own the target. And what happened to the evolution of ownership over time. This is data that we collect. And this is one slide. Are there any questions so far? Okay. So what I want to do in the next sort of 40 minutes or so, 45 minutes, is give you a sense of evidence of the impact of activism on the firm. Okay? And there's going to be several parts to it. I'm going to begin by telling you, or we're going to talk a little bit about typical strategies, what's the amount of stakes as the BBL, but more importantly, I'm going to begin with the initial price reaction. That's an easy place to start. What happens when you file with the SEC and you say, I'm Bill Ackman, I want to engage with JCPenney, here's what I think ought to be done with the corporation. Okay, so what is the market anticipating when it first learns of the activist survival? We're going to look at the short and long run impact, both the stock prices and performance, and talk a little bit about all of these changes. And then I'm going to talk about two specific papers that go beyond profitability, but dig into total factor productivity based on census data and innovation in these target firms using USPTO data. Okay, so we're going to look at various ways to unpack the impact, the short and certainly long-term impact on firm performance. And in this sort of next 40, 45 minutes, I'll also then try to say something about the impact on other stakeholders, what happens to employees, what happens to CEOs, and all these other stakeholders in the company, we'll try to say something about them, what happens to bondholders, okay, when an activist shows up. So we'll talk about that. And this is sort of the biggie, right? It's tough, very hard to handle. I'll try to tell you about various ways in which we try to tease out causality, because even if I show, remember the hurdle here, the problem, is that even if I was to show that when ICON comes in, the firm does it normally well, how can we tell that it's due to the effort expanded by the activists? Icahn is a shrewd investor. He's been doing it for several decades. He probably knows how to anticipate where the industry is going and what's going to happen going forward. Maybe just start picking. Right? It's just so we need to think about that, and I'll try to give you answers to that I would argue are such that some of these effect holding would have not taken place had it not been for the effort expanded by the activists. But I can tell you outright, there's no doubt that there's selection. There's no doubt that these are shrewd investors. Nelson Peltz has been doing it for several decades. Ralph Whitworth, who just passed away, has been doing it since the 80s. All of them probably have a selection. They probably can anticipate how these firms will behave going forward. And so selection is part of their agenda, how they operate. So we'll get to causality and describe how we try to deal with that. And then, hopefully the last 20 minutes or so, we'll have time. I want to talk about some very interesting research that other teams are doing that look at, for example, hopefully I definitely want to get there. For example, right? So one of the things that a couple of teams or authors have said is when you just look at Icahn engaging with a corporation, you're understating the impact of activism, because in many instances, boards and managements fear the arrival of the activists and take proactive actions in order to mitigate the propensity that the activists will show up on their doorstep. And so these papers try to quantify that, try to see what happens, what kind of actions do boards take, do management take, what happens to firm value just due to the threat of activism. Okay, so there's that kind of research. There's research that looks at what happens to rival firms in the same product market. Very interesting research that looks at liquidity and block formation leading up to the arrival of the activists. So I'm going to try to all of them talk to Wolfpack when we get there. This is all new research by other teams. So this is a good starting point to think about the impact of that. So on the left-hand side, it's like the standard showrun event study. Okay, so what I'm drawing here from 10 days before and to 10 days after is the date in which you file with the SEC. This is day 0. I'm tracing out two things. I'm tracing out the buy and hold, average buy and hold abnormal return. And in orange, this is abnormal turnover. Okay, so what you can see is that buy and hold abnormal return levels out at about 5%. Most of it in the period leading up to day 0. Okay, we're going to talk about it in a minute. By the time that you realize that the activist is there, they trade it up to the point where prices typically reflect the future value of activism. And there's clearly a lot of trading that seems to be happening, peaks in T-8, T-7, prior to the filing. Right? And so a lot of turnover, you can see here more than double the normal turnover for these corporations. Okay, so the first takeaway, it's clear there's a very strong price reaction. When you compare it to price reaction to the activism by CalPERS or any one of these early forms of institutions, nowhere close to much higher. 5%, I'm going to show you in a minute. This is, I don't know, it used to be that my knowledge of market efficiency works, so it works here. I don't know if you feel guilty or not. But you're going to see our work, other people's work. This seems to be a reasonably unbiased price reaction. There's no evidence of negative alphas or positive alphas for years after the event. Okay, I'm going to show you that separately. But of course, the fact that prices go up, what does that tell you? It's consistent with the market saying, well, Icahn is going to structure the company, they're going to cut costs, they're going to change the strategy. But it's also consistent with other sort of less, other interpretations. For example, again, this is market timing. Maybe it's just about stock picking, right? Icahn knows that Netflix is undervalued. Icahn comes in, buys Netflix, price goes up. But it's nothing to do with sort of fundamental changes that he will enact. On top of that, not only are you worried about stock picking, but maybe it's not about long-term creation of changing the business strategy. Maybe it's about a wealth transfer. Maybe all that I'm doing is transferring wealth from bondholders, from employees. I'm going to try to give you some evidence whether that can explain this very strong change in the value of the firm. I don't think it does, but this is clearly something that we'll touch upon separately coming up. So various interpretations, as I said, I'm going to show you that it seems to be an unbiased reaction. It's very easy to rule out market timing. One way to rule it out, you can look at a subset of events where the market knew that icon was already in the stock, either because they filed 13G or based on their 13F. So the market knows that icon is there. Now the switch is saying files a 13D. I can rule out that they're surprised by the fact that icon has showed up because they already knew. Okay? Which strategies tend to generate a very strong price reaction? Not governance-related changes per se. So if you just wanted to stagger the board, remove a poison pill, put a guy on the board, that doesn't move prices a whole lot. It has to be about fundamental changes, right? So spin off that division, put yourself up for sale. Putting the firm up for sale is the strongest price reaction, on the order of 7 or 8%. Okay, but it has to be fundamentally about restructuring the firm that drives these, strong price reaction. Governance or even more mundane changes to payout policy don't generate as big of a price reaction as these more restructuring changes that I just saw. Okay, but I'm going to focus in a minute now on the graph here on the right-hand side, which I didn't describe yet. So what I've done with this event study is I centered on the day in which you file with the SEC. You gotta remember, when you think about it, you accumulated more than 5%, that's your cost date. Now, it's up to you to decide whether you're going to take 10 days, but you can take 2, you can take 1 and file with the SEC. There's a heterogeneity there. So rather than sorting now or centering on the day in which you file, I'm going to center everything on the day in which you cross. Right, so the only thing that has changed the point at which I'm centering. Instead of having this, I now have that. Now the turnover picture is completely different. Right? This, hump is basically, averaging across these spikes. The way to think about this is what is happening is that the activist chooses to cross, and they cross on a day where there's a lot of turnover. But within a day or two, turnover just goes back to normal. But when you take these cross dates that happen at different intervals relative to the filing date, now you center everything around the filing date, these spikes turn into this mushed version of turnover. But effectively, all the high turnover occurred on the day that they crossed. Very little evidence. You can see that within a day or two, turnover goes back to normal. Okay? And I think that, again, this is not our work, but there's a lot of interesting work that is happening now. I'm trying to understand exactly who's trading, how exactly trading takes place around this period. And so I really want to focus on, Pierre and Slava's work, that one of the clever things that they have done is, John.
Just to clarify, you said when they cross, can you define what you mean by when they cross? Cross what?
Cross means that, remember, the SEC says that whenever you have more than 5% ownership of the target and you want to influence control, you cross that threshold, you buy more shares, you have 10 days. So I may have had 4.5% on Wednesday. Today, what is able to buy 1% more, that's my cross date today. And now I can take up to 10 days to actually make the filing with the SEC.
How much did that buy with the cost?
So this is where Nick Gancha looks. I would say, again, this is I would say 0.5%, 1%, 1.5%. I would say that's the range of changes. And The question is, what we don't know really is how does it come about? So I would say Slava and Pierre, they have several papers on this. They will probably argue that the way to think about it is that the activist is kind of building the block, obviously he doesn't want anybody else to know, and then they're waiting for big uninformed selling. And then they gobble that. And that's how they cross. And I would say Nick, with a different data set, using a certain data set, tries to make the same point. Okay, so how they build a block, you have two different sets of authors trying to model that. And what is interesting, another interesting aspect of trading here is that Jan Schnitzler and Wolf von Lillefeld-Toll, what they've done, and this is sort of a sort of more recent paper, they went and dumped all the 13Ds that are out there, not only hedge funds, private equity, banks, founders, and they say, when we do this exercise, we find it for them as well. You see the same spike. So there's something about the trading of insiders in general, and informed block orders that we don't fully understand about how this particular event takes place. But you cross on a high turnover date, and then it takes about a week to 8 days for the market maker or somebody else to try to figure out that there's an informed block order out there. Prices go up, such that roughly by the time that you file, price reflects present value of these additional changes.
So is it the turnovers because these guys are buying to get to that?
I'm sorry?
Is it that these hedge funds are buying to go over the 5%? Are they the ones creating
So that's again, so if there is additional buying by these hedge funds, it's probably not a big deal.
No, on the day of the cross.
No. So it's not, and so that's sort of the where I'll talk about this towards the end of the presentation today. The question is, how do you interpret this high turnover? Some people say, well, we see high turnover, it must be typical. Right? Well, if the activist doesn't buy, then it has to be somebody else who's told that the activist is crossing. The more innocuous explanation is, again, is this timing, which Slava and Pierre provide more evidence, that I'm simply buying on a day when a bunch of mutual funds just kind of selling and dumping a lot of shares in this underperforming firm. But we don't know enough. I mean, this is one of the questions that more data would be useful to sort out these questions. Now, you may say, fine, you told us 5%. What's the evidence on long-term? And Espen is sitting here, and he's done this for many, many years. There's various ways to measure, abnormal performance going on the long run. You could do buy and hold, you could do calendar time portfolios. I'm doing it with my favorite method, which is calendar time portfolios. It's kind of simple. Again, it hasn't been done that you buy and hold, you get the same results. But what I want to show to you is that if you trade after the announcement, once prices have moved, everything has been incorporated into the stock price. So the easiest way to do it is just to create a trading strategy, for example, where I'm going to buy the firm that has been targeted, added to my portfolio, equal, evaluated, and hold it for a fixed time point going forward. For example, if you do that, you buy at the end of the first month after the arrival of the activist in over 3 years, right? You get, on equally weighted basis, you get 25 basis points insignificant. If you do it on evaluated, you get 16 insignificant. You want to go 5 years out, 24 basis points insignificant, minus 3 basis points. It's 0. Right? So we don't find any evidence that the market didn't get it right. It's just what I expect to see. On average, 5%, and no drift afterwards. You can even run this exercise after the activist has left. Right? Because some of the criticism was, well, the activist is there, but the moment they dump the firm, that's when all hell breaks loose. Well, you can do that, right? You can create a trading strategy that buys all firms where activists have just left and hold for 3 years. Again, if anything, this is like too big and positive, I would say. So we don't find, and as I said, one of the things here is that not only us, Chris Clifford, this is his PhD thesis, ran this regressions, same set of results. Markoveth and co-authors, they do it even for broadly, US and outside. I would say their unconditional average results are the same. Wonisatka has a paper where they're interested in how different hedge funds how different hedge funds match with different firms, what happens to long-run returns. They look at conditional results consistent with this. So different teams, different data sets, all end up with prices don't, market gets on average correct. What about profitability? Okay, so there's various ways to look at, say, profitability. I'm going to focus on profitability. There's also results here on Q. But let's look at return on assets. One of the things that you could do is for every target firm, pick a matching firm, say propensity score matching, same size, within the same industry, same valuation, and importantly, control for past valuation, right? You want to control for any mean reversion, right? So I'm not going to pick a control for the treated firm based on its valuation at T-1, but I want to pick how a control that matches the valuation at T-3. Right? I want to be able to control the fact that these all firms are underperforming, and that's why the activist is selecting them. So this is the propensity score matching that I have here for you. And when you look and you do a different diff, you find that the treated firms, right, all of these different diffs are positive, in this case significant. Okay. Now I'm not saying that this is all treatment due to the activist. I'm not. Right? This is when to get to the causality, set of results. But even if you don't buy any of my tests and instruments and counterfactuals, you don't see this negative, right? The diff is not negative, it's positive. Okay, so this we should agree, we don't see evidence of underperformance. This again with firm and near face effects. Okay, you can play around with adjusting for the listings. We don't see evidence of underperformance. If anything, it's the other way around. But what we try to do, and what I'm going to try to do in the next 15 minutes or so, is unpack that result. We're not that happy with profitability. We want to say something more about, where ultimately they're now really thinking about how do they do it? What is it that they're changing about these firms that leads to, say, profitability to improve, okay, or the market anticipating higher shareholder value. So the first paper that looks at that uses census data, and think of it as a paper that leans on two data sets, two initial data sets that, the census of manufacturers and the annual survey of manufacturers from the census. And so what you get from that, you get data on shipments, capital stock, investment, labor, material, energy. So I'm going to fit a Cook-Douglas production function in a minute. Nothing new has been done in the past. And effectively, the way to think about what's the exercise that we're going to run here, you have the value shipment, so you have sort of output on the left-hand side. You're trying to model it and say, where does the treated firm rank once we control for all the inputs into the production function? Where does the residual look like? Is it positive or negative in that year in industry? So I'm going to grab a residual, basically, all relative to the average firm in the industry in year, and trace what happens to total factor productivity, that residual over time, pre to post event. And that's the exercise that we've done, and I want to show you the data, at least the main result. First of all, for plants that have not been reallocated, plants that the treated firm chooses to retain, we find that they improve in total factor productivity. But just as an important result, if you look at plants that will be sold, okay, so within 2 years after the arrival of the activist, we look at all the sales and match plants of treated firms to plants of these control, same industry, same size, match such that their performance decline is identical or similar leading up to the year of the sale. So again, we're trying to be very careful about mean reversion. But what you can see, there's something about the reallocation process where plants in the treated firm tend to rebound, tend to generate higher productivity, unlike what you see from the plants sold by control firms. We don't see any rebound. Okay? So then the nice thing about the census is not only can we say something about productivity of plants retained and plants sold, you can, for example, talk about attrition. The other thing that worried us even in our first paper is, as I said, the key objective that generates the highest economic return is sell yourself or sell some of those divisions of yours because you're not running them well. Okay? But if you sell yourself, you leave CompuStat. You leave CompuStat, I've got attrition bias. Which sign does it go with? Right? Census, even if the plant or the firm disappears from CompuStat, I can trace the plant with the new ownership. So one of the things that we've done with the census paper is say, what's the sign on that bias? Once we disappear from CompuStat, we see those plants. How do they perform? If anything, they perform better than their matched peers. So this is sort of evidence from the census paper. I'll come back to it later because one of the things you can do, you can ask what happens to employees. Right? These are sort of one important stakeholders that we care about. And so I'll come back to it later when we will talk about other stakeholders and report to you what happens to their wages and their productivity after the arrival of the activists.
Just to clarify a question. When you sell these plants, is it the buyer or the seller who's doing the improvements?
No, so these are they're already owned by, like at this point, they're already owned by...
They're still owned by the...
No. So this is already now in the new management, right? So it's a new management. When you look under, now that the plant has been reallocated, total factor, that residual seems to be higher than it used to be.
So you sold it to somebody that improved it?
Yes, and you're going to see the same message.
So it's not the activist who's doing it, it's the next guy?
Right. So the question is, what is the activist's role in this reallocation process? There are two papers online that I'm going to come back to. This is very important. So I'm going to maybe wait with this. Two separate sets of authors that have tried to talk about what do activists effectively, how do they shape the market for corporate control? Okay, what is it that they do? Do they expand? Bidders is now bigger. What is it that they do? Do they intervene and simply push you to pay a bigger premium? I'm going to talk about that. Now, so we have one paper that looks at sort of plans, but of course the census data is only for manufacturing firms. I want to look at other aspects of activism, which is as long as out as you can go, which is innovation. Okay, there's several papers that look at innovation in various contexts. Sarah's PhD thesis, Shai Bernstein looks at going IPO and innovation. I'm going to look at activism. And this is up from a current working paper with Xuan Tian, Song Ma, and Wei Zhang. And just to think about innovation and activism, talking about Larry Fink, everybody knows CEO chairman of BlackRock, so had to start with this quote from Larry Fink. So Larry Fink writes this annual letter to, I guess, the top 500 firms. And this is a very convenient, trying to write a paper and trying to motivate it. So he comes out in March of 2015 and he says, in response to the acute pressure growing from every quarter for companies to meet short-term financial goals, at the expense of building long-term value, this pressure, where is it coming from? It originates from a number of sources, the proliferation of activists. Right? There's no empirical evidence, but it's really asserting that activists are short-term. And so I want to tell you what we find when we look at innovation. But before doing so, let me quote him from the most recent letter. Right, this is a letter that he wrote right in February 2016. So now he's not mad at the activists, he's mad at the boards. He's saying boards are not doing their job, they're not looking strategically out enough. And in fact, he says, those activists who focus on long-term value creation sometimes do offer better strategies than management. And in those cases, BlackRock corporate governance team will support the activist plans. To what extent? During the 2015 proxy season, in the 18 largest US proxy contests, BlackRock voted with the activists 39% of the time. Right? So This is what I said when I started the talk today. You got these big passive institutions, they have the governance team. If you can convince them to be on your side, they'll be on your side. This is what we want. We want democracy and let the party with the better ideas win. But I want to show you now, when we learn on the impact on innovation, and let me set it up first of all, we're going to move in here. So how do you measure innovation, right? It's not that easy, and we're going to kind of lean a little bit on earlier work. It's not perfect, but earlier work, going back to Josh Lerner, as I say, Shai Bernstein, begins with using new patents as a measure of innovation. Not only new patents, the quantity, but sort of how exposed, how well cited are these patents. The way to think about it, if you've got a good patent, it will be commercialized, new products will be generated, they'll cite that old patent. Okay, so new patents and citations, and what you do here, we're going to look at firms that we call innovative, that have at least 1 year of R&D prior to the arrival of the activists, one patent, few patents. We're going to look at that set of treated firms, about 550 of them, that's my sample. We're going to run again with a propensity score matched, the way I described it before, set size, industry valuation, change in valuation. They're going to be my counterfactual for now. And I want to show you what happens to patenting activity and the quality of the patent. So what you see prior to the arrival of the activists, right, there's no pre-trend. They're not different from their controls. But within, I would say, 2 years, it turns significant, and you're creating more new patents. More new patents that are actually more highly cited. These are lifetime citations. These are citations going forward. They create more new patents. Now, what happens to R&D to get these new patents? If you look at dollar R&D relative to the controls, it does go down, consistent with the people who criticize activism. But remember that the firm is changing its boundaries, right? These treated firms don't remain as big. Typically, they share these peripheral divisions, so their asset base goes down. If you scale by something like book value of assets, now R&D is insignificant. It doesn't change relative to control. Okay, so what effectively is happening, you've slimmed down, you're more efficient, and that dollar of R&D gets you a bigger kick, you'll be more successful. But you may say, you know, how does it come about? What is it that they do? Where do they innovate these treated firms such as they do better than these controls? Okay? So what we've done, several things. First of all, treated firms, all that action in more patenting activity happens to firms that early on were very diverse. These are these conglomerates that the activist is going to say, hey, I want you to become more efficient. Okay, they are the ones who basically drive that result. You then ask, fine, you create more new patents. In which technology class? Right? Because all of these conglomerates were basically creating new patents in different technology classes. They end up creating new patents in their key technology class. Okay? But then when I say, fine, if you're creating more new patents relative to these controls, maybe, I don't know what's the best analogy. It's like, you've worked on 6 papers on no, what's the taxes actually? You've done 6 papers on taxes, and now you're going to do the 7th, right? You're going to say, okay, that's not fine. So you get more, but who cares? So what we do, we look within your key technology class, and what you can do is say, you created a new patent. Let's see what other patents that it cite. Is it simply citing more of your older patents that you created? Is it exploitative? Or within the key technology class, you're citing something else. You exploit it. Again, relative to the propensity score match firms, these new patents are explorative. You're just not doing more of the same. Okay? That's with respect to the new patents. Now, you create more new patents, maybe 1 or 2 per year, but you have a basket of patents that you already own. I talked about selling peripheral divisions as sort of the one key theme of activism on average. reallocation of patents. Okay, what happens to the basket of patents that you already own? So what I've shown here is, again, these are patents that are sold. Right? This is the year in which they're sold, again, within 2 years of the arrival of the activists. These are the citations that these patents receive. And again, these are citations they receive once they're with the new management. The counterfactual, again, is patents sold by the propensity score match firms. Again, they're sold, so not surprising that there's a decline, but we don't see a rebound in citations received. So how do we think about it? I'm the treated firm. I'm selling some of the patents that I own. By the way, these are patents that you consider as peripheral. You can measure the distance between any one patent and the basket of patents that the firm already owns. And always one thing that the key variable that explains the propensity to sell is how close is it to your core capabilities. The further out it is, the bigger is the chance it's going to be sold once the activist shows up. Okay? But now, so in Espen, I'm coming back to a question about how to think about, why is it that you see more success going forward? So the treated firms sell peripheral patents that seem to be doing better than the new management relative to the counterfactual here, which is all patents sold by the propensity score match firms. You may say then, maybe it would have been best to retain them. I don't know, that's sort of possible. So we were trying to think of other ways, or of other counterfactuals. So rather than look at this counterfactual, think of other counterfactuals. Right? So here's one. What I can do is anytime you sell a patent as a treated firm, I'm going to look at the propensity score match firm that I matched you to and look at its best patents that it does not sell. Right? Because if your concern is that maybe they should have retained these patents and not sell them, I'm going to benchmark the patent citations, the patents that you do sell, to the best patents that have not been sold by the propensity score match firms. I want to see how you do relative to that much higher benchmark. Right? Maybe you should have kept on to these patents, and you would have received the same citations as the patents that your peers have held on to. If you do that, you get essentially the same message. Right? So the default, the increase here is steeper than the increase that you get for the much higher threshold. So the only message I'm trying to send here is that this reallocation mechanism that activists bring about, we saw it with the divisional reallocation. We see it here with patents. Okay? Now I want to come back to say, any questions? Yes?
Where are you getting this information about the patents? Where's that coming from?
So there's 3 different data sets. That's why it took, this is like 4 years of, building this up. To use PTO, you get, and extensions of it, you can get the patent citations. There's a different data set, which is patent transactions, which you have to clean up. That's where that previous analysis was based on. And then there's a separate one, which I'm not even talking about today, which has to do with the innovators. One of the things that we ask is, what about the productivity of the innovators? So after the firm has been treated, are they more or less productive? That's a separate database from Bloomberg. But all of these sort of describe it. So let me talk a little bit about stakeholders, because that's sort of an interesting question. Employees in particular. Okay? So one of the things that we did with the census, I said I'd come back to the census paper that we had. The census allows you to track wages and labor productivity. And what we found is that labor productivity goes up, but not wages. You're getting more out of employees. Okay? When you try to sort of get a little bit originating that result, you're kind of squeezing more out of employees, it seems to be coming from industries that are highly unionized. Okay? So maybe you can tell some stories about unionization, some association between management and the union. Maybe you're not leaning on employees as much as the activist is willing to do. But the message from that paper was, you're getting more productivity with wages not changing, more of it is coming, for example, by sort of from the white collar workers. And I have a quote here. This is a very nice article that was written by Walter Frick, who writes in the Harvard Business Review. And I thought what he did, maybe what we should have done, is he kind of put it in a broader perspective. So I'm actually going to read these two paragraphs to you. I thought this, so again, this graph is for Walters, right? So he's kind of tracing out a broader trend since the 50s on income, employment, and labor productivity. Right? You see sort of, as we know, median income and level out, productivity just keeps on going. So what is he saying? There are two stories you can tell about finance in America. The first, the financial sector helps grow the economic pie by shifting resources to people and firms that can put them to the best use. And the second, mostly is capturing value rather than creating. Okay? That's the tension between the two accounts of what finance does. It's easy to argue for revenue in Wall Street if investors are squeezing workers without creating any value. But actually these hedge funds seem to be creating value and capturing a higher percentage of it. Both stories seems to be consistent at the same time. It's based on what we see here from employees. So I thought just linking it to the broader trend was sort of a nice article. So that's one stakeholder. What about other stakeholders? So what about bondholders? So April Klein was first to write on what happens to bondholders. Obviously with bond data, you just have no, the data is kind of very hard to get. And so April wrote a paper on what happens to bond yields, to the ratings of these bonds. But you can see I quoted virtually all of these authors are getting at the same question, by and large. And the takeaway that I would kind of take from this literature that looks at wealth transfer from bondholders is that it depends. If I'm coming in and saying, do a REIT spin-off, which I guess you can't do anymore, but if you basically sell out of tangible assets, bondholders are probably going to be harmed, especially if they don't have good companies. But if you're structuring the firm and you're increasing the pie, you're making the firm stronger, bond yields may even go down. So I think it really hinges on what precisely is does the activist have in mind in driving wealth transfer or not from bondholders. Okay? So employees, bondholders, what about incumbent CEOs? Incumbent CEOs don't particularly like activism. So CEO turnover doubles relative to the Compusta average. Okay? What happens to their pay? And this is a paper that just been circulating by Thomas Kirsch from INSEAD. And what Thomas Kirsch does, he, again, same propensity score match firm, try to do as many matching prevent characteristics as you can. What I'm tracing here is, again, this is a CEO turnover, which spikes in the year of, the year T+1, even a little bit in T+2. But importantly, look what happens to the variable part of the compensation, the pay-for-performance part of the treated firms, pre to post. What he shows is that in the 3 years leading up to the activism, again, once I've matched you in T0 to the propensity score match firm, now I'm going 3 years back. You can see that initially when they were matched, there was no difference in that variable compensation part. But as you edge into the year of the activism, that sensitivity declines relative to these match firms. Activist shows up, boom, right? It's reset. Okay, so that's the variable component. Now, interesting, what happens, John?
So you showed some reactions that are obviously positive for the firm. Are you interpreting most of these things as always improving, or might some of them be harming the firm? More CEO turnover, is that a good thing, bad thing, or can
So let me talk about CEO turnover in a minute. Okay?
just generally speaking, are you still interpreting these largely as positive?
I think the reason I said I'm going to come back to what happens to stakeholders, remember I showed you that price pop early on, that 5% pop. And one issue that worried us 10 years back was how much of that is due to wealth transfer, from whom, debt holders, etc. So what I can say is probably not from bondholders. Okay, it might be a little bit from employees. Okay, Okay, and I'm describing sort of, how to think about CEOs. What's interesting about CEOs, yes, they clearly seem, the turnover seems to spike, and now their pay is much more tied to performance. What about the level? Okay, what's interesting about Thomas's, what he finds for the level, I don't know if you set a graph here, he finds that it doesn't change, and if anything, if you want to bring somebody in, you have to pay more. Okay, so the level, there's no evidence about you cutting, pay by half or reducing it significantly. It's about incentives. But no, he doesn't find any impact on the levels of the level of pay. Okay, so John, let me say one more thing about your question. CEO turnover, one answer to John's question about beyond wealth transfer, how do we think about what has happened, say, to the CEOs? There's a paper by Luigi Zingales, I think it's in the AER, where Luigi says, if you've got more institutional ownership covering the firm, it gives cover to the CEO to innovate. That's their story, there's a model, there's some empirical evidence. What is interesting in what I showed you is that here we have a lot of CEO turnover. So you might be worried that this may not be consistent with my evidence on innovation. If now the CEO is being replaced, why would they have an incentive to think about the long run? What we find is that conditional on replacement, the tenure of the new CEO is longer than the tenure of CEOs that have been replaced by the propensity score match firms. Okay, so there is a link here, if you think again about incentives and sort of long run. Again, the tenure of these newly placed CEOs is actually longer than their match peers.
So they're being forced out, do you think? The CEOs?
It's subtle, right? Let's take an example, right? There's clearly some of them when you write a nasty letter, who's the CEO that didn't have the Vita, didn't have the right. I'm not thinking about those, but let's take a more subtle example, like Alan Kuhlman from DuPont, right? If you think of Alan Kuhlman and DuPont, Tryon went through a proxy contest with DuPont, and the whole game was about getting Nelson Peltz on the board. That was it, right? And the board resisted. Alan Kuhlman resisted. They went to a proxy fight. Alan Kuhlman won, right? Tryon did not get any of its representatives on the board. That was May 2015. October 2015, she resigned because earnings came down low. Now, is it because of Tryon or is it sort of random? I would say it's probably because of that pressure, right? That you knew, So it's very subtle, even though you might say she won proxy, I would say it is that pressure that led to a replacement. So let me talk about causality. How we do this? How we what's the time? Yeah, how we doing with time?
It's 3 o'clock. Good half an hour.
Half an hour. Okay, so I'm going to spend 10, 15 minutes on this, and then I'm going to, I really want to spend time where the literature people have been doing. So, why is this problem, why is it tough to say that all of the changes that are shown to you were driven by the activists? Of course I can't do it, because we know there is selection. In fact, that's what the problem is. There's no sense in looking for instruments of randomly matched call icon to a randomly matched firm. It makes no sense. At any point in time, however you're going to shock the menu of firms that they can select from, they will select. So I need to think about how to deal with that selection. Of course, you could look for instances in which the activist has been paired with the treated firm. You look, for instance, where there perhaps exogenous shocks, or in the CEO literature, or there was CEO death, and CEO, there's just not enough of these. Unfortunately, I guess for the activists, there's maybe one such event recently, you can't use that. So I'm going to show you a different kind of way to try to identify some of the effect of activism. What I want to basically do is say, let's condition on the matching, and then look for instances in which I can vary the effort level that the activist expands vis-a-vis the company And if more higher effort is going to, relative to no effort at all, going to lead to better performance, I can attribute that to the causal effect of the activists. This is where I'm going. But before doing it, just look at the environment of the sort of where all this is happening. If in fact none of this would have taken place, none of this would have taken place, even I can file the passive 13G and did not engage with the company, then why didn't I can do it? Why don't all of them just do it? Buy passive, buy a block instead of engaging with the company and saying that you want to change all these policies. Just sit tight, file this different form, which is less onerous as a 13G, and wait for things to be revert with no effort whatsoever. And you are bearing a lot of effort. Remember, I told you that these activists, bear a lot of idiosyncratic risk. In DuPont, try and put in about $2 billion, it was like 1/8 of the fund. You're bearing a lot of risk. If this is just about a mean reversion, be more diversified, hold on to these shares, and just wait for a few years for these things to kind of perform well. So you're bearing this idiosyncratic risk. As Nick Gancher was showing in his thesis, it is costly. These proxy fights, certainly when you talk about the large caps, they're very expensive, on the order of millions of dollars. Why bear it if it's just going to happen anyway? So this is aside from an instrument or what's any kind of factual, just looking at it suggests that you probably need effort here. It wouldn't have happened otherwise. So there's several ways to do this. Let me begin with several kind of factuals. So as I described it in the way when I talked about the patent selling, right? Patent selling, I looked at the propensity score matched firm selling of patents as a counterfactual. I looked at the best patents by the propensity score matched firms that they don't sell as a counterfactual. You can look at those as counterfactuals. You get this sort of same results that I described. Another way to do it is to look at the quarter of the events in which there's hostility, where I say, I want you to sell that division, and manager says, no, go away. Right? So in those cases where I threaten with a shareholder proposal, threaten to sue the company to go all the way to proxy, which we call as hostile, if I do see positive changes, the more likely than not, it would have not taken place if not for the activists. That's what we find. Right? If you run the exercise with the census results, with the innovation results, even in the hostile engagement when management was opposed to the activists, you see a rebound. Okay? Here's another one. Here's another sort of way to work, to think about, to try to get around this idea of mean reversion. What we do in the census paper, we say, here's a firm, it has a bunch of plants. Let's say it has 10 plants. Maybe 8 of these plants are in their core industry, and 2 are not. They're peripheral. If it is about just forecasting where the industry is going to go, if it's just about mean reversion, maybe those 8 are going to improve, but less likely that the 2 will, because you're not forecasting that. That's a peripheral division. You look at the peripheral divisions, you see a rebound as well. There's something about changing the firm, that's just about forecasting the core industry. And let me say one more. Perhaps sort of the cleanest, all of them sort of are imperfect, but here's one more. You can look at instances in which the activist was passive, right? Because, general partners, if you look at their portfolio, some of them are active, some of them are passive, some of them just bet that the particular holding is going to do well. So what I can do is look at the passive ownership and benchmark, that's what is served as my counterfactual, and look at instances in which you had a 13G, a passive ownership, but you switched it to a D. When you do that, ownership doesn't change. So I'm going to compare the performance of the firms in which there was a switch from passivity to, I'm going to put in the effort, relative to that benchmark of passivity, and what's effectively is going to happen. Those switches, both stock picking and potential intervention relative to just stock picking, that diff ends up being positive as well. So, and there's 1 or 2 more which I think I'm not going to talk about, but all of these are different ways let me try to get at this question and my conclusion is that some of those changes that have shown up probably would have not taken place but for the activists, but surely some of it is about selection, right? Because some of these are very shrewd investors. So, as I said, let me skip that. It's about the market for corporate influence. If there's any takeaway, you cannot do a whole lot with 6% in the firm. And in large caps, where you have 1 or 2%, there's no way that management is going to listen to you unless they're worried about what Larry Fink thinks. And as we've seen, Larry Fink in 2015 already votes 40% in favor of the activists. That's the name of the game. And if they're wrong, they're going to lose. That's fine. Okay, but new ideas are going to be generated that ought to be debated. And now I want to spend the last 2 slides just giving you a little bit of where this literature is going, just to show that there are many teams that are jumping in with looking at various aspects of this. So, as I said, one very interesting, there's one paper which already came out of the JFE by Alon, where they look at what happens to rival firms. So, if I go after Espen, what happens to another firm in our same industry? And what they show, that it really hinges on, is that other firm weak or not. To the extent that it's weak, it's financially constrained, its prices are going to drop at the same time to see an announcement that I've targeted him. So evidence on what happens to rivals. And as I said, this is a very interesting and tough set of papers on the threat of activist investors. Here, they kind of say, look, you're looking only like maybe 10% of publicly traded firms that are being targeted, but what about the rest? And these papers try to show that, and we know it's true, like if you just follow, there are a lot of firms out there that now engage with corporations to do drills, how to prepare for the arrival of the activists. Right? And tell boards, believe it or not, that they need to talk with their major shareholders. Okay, that's how messed up is the system, that up until activists showed up, boards did not even figure that they need to reach out to the top 5 or 6 block holders and tell them about strategically where they're going. So a lot of what is happening is that even absent any engagement, boards are now felt compelled, in my mind, to do the right thing and think about what they're doing, why they're doing what they're doing. And these papers are trying to identify. And in many ways, just one little sentence here, the reason this is challenging is that I think it's very, very hard to identify the causal impact of ICA in that. It is doubly challenging to identify the causal impact of a threat because it's unobservable. How do you shock it? Right? So, but that's where these teams are working on. For example, as I said, there's interesting work by Ronnie Sadka and others that look at, can we say something about how the hedge fund is organized? What kind of disclosure does it have? What kind of lockups does it have? How is it set up? And whether there's interesting sort of matching between funds and target firms. Okay. Some work that looks at activist reputation, right? And what happens with how reputation allows you to, which kind of firms do you engage with. All of these by different teams that are currently working. You see most of these in 2015, 2016. Here's work by Alex and co-authors. So Alex and Anat, the software here is just giving the talk right now, but Alex and Anat wrote theory papers that talk about exit as a threat, as a governance tool. Right? So some of the work that's being done is trying to say, when is it that you adopt one versus the other? Exit versus voice. Okay, so these are theoretical papers by both Slava and Alex. And now I can come back to the market for corporate control. So there are several papers. So Kurum and Levitt is more a theory paper, but 2 empirical papers. So this is by my co-author Wei Zhang, where there they condition already on a bid being there, and they ask what happens once there's a bid. What do hedge funds do? Once they come in, what happens to completion rate? What happens to premia when they basically say don't do it, or this is too low, and to try. And their conclusion is that when activists come in, the propensity to completion declines only a little bit, but they're able to squeeze out a lot more from these bidders, or if the firm goes private. What Anushka Desani, Nick Gunchev, and Nicole Boyson do, I don't know if one of them is here, is talk about what effectively happens to, how do you put firms in play? What happens prior to there being a bidder in terms of the market? How do you shape the market for these firms? And so two different, essentially, papers that get into the reshaping of the market for corporate control by these activists. I'm going to maybe spend, if I give John left, I don't know what the time is. I don't want to go over time. 5? 20 minutes, okay, so that's good. So maybe we'll finish before that. I want to touch upon some of these. How do you kill activism? If I have to ask you, what's the best way, if you were a good lawyer and you didn't like activism, how do you kill it?
Bylaws.
What do you have in mind? The firm bylaws?
Yeah, firm bylaws.
Yeah, actually, so I'm going to talk about it. I don't think that's going to work. Right? So I'm going to talk about poison pills in a minute. That's not going to solve activism. But that's coming up. But if you wanted to make activism costly, too costly, what do?
Private.
What is that?
Go private.
Let's assume that it's still fine to be publicly traded. How do I make activism not profitable? Remember, I spent a lot of time on the Schedule 13D rules, right? The Schedule 13D rules currently state that they passed in 1968, right? The Williams Act, they say you cost 5%, you got 10 days. What's the easiest way to
Increase the percentage.
What's that?
Increase the percentage from 5 to 10.
No, then we're wrong, right?
Decrease.
Decrease it, right? Just say, you know what, you got to stop at 3. Once you stop at 3, you don't get to buy any more, and you have to file immediately. And by the way, no derivatives. Okay, that's easy. So the more that you constrain the stake size that they buy, you're going to kill profitability. And immediately, when activism became somewhat more prominent, you already saw filings with the SEC rulemaking changes to do just that. No change has been made to date, okay? But the evidence will clearly come to bear on whether you do want to change it, because if you thought it was bad, you probably want to change these filing rules. But if this is good, it's about increasing shareholder value, it doesn't seem to be harming other stakeholders, for the most part, then maybe you don't want to mess around with it. The other aspect is sort of kind of back to what you said, and this is a discussion that I had with Espen after his talk today. There were a lot of changes in the 80s, right? Poison pills, all these combination laws, and a lot of changes, fundamental changes to the law. There's none so far with activism, okay? And what's interesting, if you have a poison pill at 20%, it doesn't matter the activism, they're never going to trigger it. The median is 6, so this, you're going to have a very low, threshold. They don't care. It's not to say that there have not been cases in which the activists bumped into the threshold. Sotheby's one case where it was set at 10, and the activist said, third point said, oh, could you bump it up to 15? But I would say those are exceptions. So there are actually papers, mostly by law professors these days, that are kind of asking us, what are the implications of activism for poison pills? Or for staggered boards, for that matter. Right? The median holding period for an activist is, if you want to think of it, a year and a half to 2 years. It depends on what sample period you measure. It also varies by what you want to do. So some activists, like Value Act, will sit on the boards for years. Right? They're really long-term, they're committed to changes. So if for whatever reason, I want to put 3 people on the board and it takes 2 years to do it, I'll just do it year after year. Okay, so I don't think necessarily the stagger boards gets you a whole lot in terms if you're incumbent management. So these issues are changing, and this is sort of, these are all papers that are reading these days about, okay, will William Brav write precisely about poison pills, and as these things are changing. And they touched upon already I want to touch upon two things and then I'll conclude. Slavos and Pierre Colomb friend, and then now joint forces carry back, and others are looking at sort of how does liquidity affect this, the interaction of liquidity in block formation is sort of very literature that dates back quite a bit. And they have written several papers that looks at block formation. And remember, the nice thing about their work is that Slava at the time went back to these 13Ds, and what he did is grab from these 13Ds, you're forced to report how you traded leading up to the 5% threshold. And anytime you bought, you have to report how many you bought and at what price. And they use that data to say something about how informed block holders trade, which to date, you haven't had too much evidence on. And what is interesting, and I think it's very clever in the paper, is to show that typically when we think about informed traders out there, you think that after selection, you think that spreads will go up because there's an informed trader out there. But their main point is to say, activists choose when to come in. They're going to come in when liquidity is high. So when you actually look at it, you're going to see an informed trader there when spreads are low. Okay? And it all traces back to the ability of using this data that is all free to all of us on the SEC website. And finally, one last sort of a mention of another piece that sort of helps me kind of conclude this lecture. So there are several papers that Todd Gorman and co-authors and others that are now basically saying it is about persuasion, it is about the interaction of activists and passive shareholders. How do they communicate? What happens in their engagement? And what they do here is build on this sort of instrument that they use in earlier work. You can get some exogenous variation in the number of passive ownership, in the extent of passive ownership that you have in a stock. Right? And so you have more of the BlackRocks of the world. What happens to the nature of activism that takes place? And they trace that in that paper. So in many ways, I start by saying, think of activism it's about persuasion and getting these big passive guys on your side. This is one attempt to think about what happens when you have more institutional ownership. How does it reshape activism? I already talked about causality. So I'm going to stop here unless you have questions.
How long do these activist firms stay at the firm on average? I know some stay quite long, but if they just stay a couple of years, how come they can affect firms' information some long term?
So I'm going to use here a clever thing that Alex told me. Alex told this in some op-ed, so Alex uses the following analogy. He says, when you bring a turnaround specialist, how long do you employ that turnaround specialist? Right. You're not going to write. It's going to be a year, or it's going to be exact. That's the time frame. You're not going to have them there for 10 years. Right. So I think of these activists that will come in. If you need to stay for a long while on the board and help shape the dynamics on the board, so value add, those kinds of, you'll be there for 4 or 5 years. But if it's just about putting it out for sale and not being successful, what's the point of staying on the board? Remember, these portfolios, mostly of these true activists, they're concentrated. You cannot be engaged in 30 different events at the same time. So my point is conclude, and I'm going to move on. Right? So I think it is plausible that, okay, we don't have, empirically, nobody's going to look at, the kind of, the type of the hedge funds, how hedge funds match the particular kind of problematic firm, how long do they stay? That's the obvious question. But unconditionally, if you tell me 2 years, I say Alex is probably why the way he thinks about it.
But if you read the media, many managers will complain these funds, they just propose to sell the assets and break up business, those sort of things, rather than long-term things.
But why is that inconsistent with long-term? As I say, it's absolutely consistent with long-term. If you are writing a corporate finance paper, an asset pricing paper, and I'm your area coordinator, I might say, hey, ditch the asset pricing, if you're strong corporate, do just corporate. I say I've done more for your long-term success in 5 different areas, and you're not going to have an impact on any one of them. So it's not clear to me that being a conglomerate and kind of being all over the place is the right thing to do. Right? The debate is, whether management somehow can justify being in more than one division. And that's where BlackRock will have to have their governance team think hard. Who's right? So coming back to DuPont, that was the debate with DuPont. A lot of the back and forth in the months leading up to the proxy fight was saying, why do you have all of these different, essentially there were like 8 divisions, but they were essentially in agriculture and chemicals and specialty. What is the value of being across all of these different divisions? Show us evidence that synergies are there, that you've created new products. Now, and so that's a valuable debate to be had. And if Ellen Kuhlman is right, she was able to convince the institutions to go with her. I don't think it's conclusive one way or the other.
Yeah, another issue is quite often these funds will require the firm to pay more dividends, like buybacks.
Yes.
You can argue this is good for the shareholders, but on the other side, these firms have less resources to really do the R&D, do the long-term development.
I agree. Again, you can tell a story for why it's bad, and you can tell a story for why there's agency problems. And again, some of these firms, when you look at one of the predictive variables, where do you go? You get a lot of free cash flow, yeah, we still. So, I'm sympathetic to the fact, look, everything that we've reported here is on average. Are there bad activists? Sure. There's no doubt, right? And that's the best that we can do, report on some averages. And there's no doubt that some of these cases happen. But it shows you there's empowerment on average on innovation, on practical productivity. On average, we don't see it. I'm sure that there are cases in which errors have happened. I'm saying this is a system where it's what as best as it's going to get. You have, when all of these institutions are bringing, all of these different individuals are all thinking about the same white paper that you put out, and management's response, whatever comes out of that is probably, I think, as close to, second best, whatever, optimal that you may get.
It's not clear that we care if they're bad activists, right?
I'm sorry?
The activists don't have control, so if they're bad, you just don't do what they're saying.
I agree.
So in a sense, it's even less relevant here, I think, than in a hostile takeover that the buyers and that hostility is bad in a sense.
That's right. The thing, of course, is that it's never ex-ante that clear. So if I say I want you to increase your buyback program or something, it's never clear, to teasing out, is it your story about this being harmful versus not? It's never that straightforward. But I think that's at least putting on the table these alternatives and debating them, I think is a good thing, not a bad thing.
So I was thinking about the patent sales, kind of interesting. So a patent, is the right to defend yourself in a lawsuit. Right? So cross-sectionally across patents, there are different costs of defending these patents. Mm-hmm. So I wonder if they're selling off the more costly ones to buyers who have a bigger war chest to defend them.
We don't know. We're trying to get data now on things like litigation, subsequent litigation. We don't have data on transaction prices, unfortunately, so we can't see, that aspect of it. But
there must be ways to classify a patent as being close to other patents out there.
That's right. That's what we do. Yeah.
Right. So the infringement might be more likely in some of these things.
So we can definitely look at that. I don't think we looked at infringement, explosive infringement yet. But we can definitely do that. Yes?
Is there a way to measure the disparity of views on the board when it comes to particular corporate decisions? Because from lunch today, the argument is if you want to know the cost of capital, you go to these 3 people, you get one answer. These other 3 people, you get a different answer. And so the one activist shareholder representative may actually shift the whole board because it's the tipping point for one of these decisions.
So I think here, so ask it again, I'm sorry.
So is there any way to find out from the members of the board of directors a view of disparity on one of the points that the activist investors are asking them about? Because if it's a
okay, okay.
particularly divided board, there might be an outsized
All right,
influence.
so this is a great point to answer and end this session. What do we know about board discussions? This is like a zero. We know nothing, right? We know zero. The best thing that we know is that they met 5 times last year. Right? So you don't know anything about it. It's amazing. To me, it's like mind-boggling. We have dozens and dozens of papers on boards and size and independence and this and that. We don't know what was discussed, how long it was discussed, right? So, but you're right in the sense that when Jeff Oven was asked about going on the board, about being on the board, he said, I want 1 board seat. Just 1. Because if I get 1 board seat, I can change the dynamics. Okay? And how do you change the dynamics? Coming back to not knowing anything about what happens in boards. And I don't know if on board, maybe some of you have, but my understanding is that 3 days before the meeting, you get an iPad with 1,000 pages to read. Right? Well, you don't know what he does. Right? Because all of them are CEOs of some other companies. What Nelson Pelzer said essentially to that question, he says, when we get those pages, when we are on the board, I have all these analysts. They're going to digest everything, and when I show up, I'm prepared. And I'm prepared to ask the right questions. And that's, I have a stake in this. So I think the way you're going is absolutely right. So coming back to I don't need to replace the entire board. It has happened infrequently. I want 1 or 2 individuals who will change the discussion, and that will probably suffice to get the dynamics to change. Sorry, I guess so.
How would this be affected by the fact that there might be an independent, the CEO and the chairman of the board positions are separate? Does that impact this decision?
I don't know that there's, it's interesting. I don't know what if people looked at the quality of decision making. Again, we don't see the decision. We see some exposed outcomes, but I don't know, if that changes. I think it would,
It's easier or more difficult for the activists, I guess is the question I'm asking.
I suspect it doesn't matter much because once they're there, they're going to ask. So even if the CEO is there, rather than having some leader, they're going to pose a question, right? So you can just manage the preemptively choose what information to present. The also person is going to know what to ask.
How does this argument of persuasion that we started with applies to when there are 2 or more competing activists targeting a point?
Oh, that's very interesting. So I see this as you bring it some issues. So one way to think about wolf packs is I guess the only measurable way they look at is to count the number of times you see activists hold the same company within, so maybe the first one shows up today, and you say how many more come within a year or a year and a half. And I think Marco Becht has done this in his paper with June in France. I think there's one more paper that I know. I would say, if I have it right, Marco counts 2 out of 10 events where that happens. Okay, first of all, it doesn't happen that frequently. But just counting events, I don't know that you can necessarily tell that they necessarily agree with each other. So Bank of New York Mellon, you've got Mercato and Shrine. They didn't agree on what needs to be done with the bank. On the other hand, you could tell other cases, I think Sotheby, where there was unanimity. So I don't know, which way it goes. But one of the things that is very interesting, in 5 years from now, if there's more activism, what happens when you got all of these guys showing up and perhaps not agreeing or arguing? I don't know which way it's going to evolve. But it's not, empirically, it's not as important today, but it may turn out to be.
The sole objective of an index mutual fund is to minimize that fund's tracking error relative to its index. That being said, it's not quite clear to me why the manager of an index mutual fund should spend his or her valuable time listening to activist shareholders and changing their voting policy from a rather naive one to one that is consistent with activist investors.
I think this is part, if we had to flip back to my first graph with the trend, governance was not that important in, the late 90s, but after, Enron, these guys care a lot about how they vote. So if you push the proxy fight, like say again with DuPont, new BlackRock, the governance team has to make a decision. Do they follow ISS? Do they follow Astus? Do they follow Nelson Peltz? So they'll have to make a decision because governance is not something, you know, that they don't care about anymore. You're going to recall your shares, you will vote them. So I think you're right in what you said, but I think it's also true the governance is much more prominent and as long-term shareholders, they do care about, you know, presumably increasing the shareholder value for the fund, for the stock, because they cannot cash out, they cannot exit. So if you can, you know, so they'll have to think about it because if they can increase the share value of these index shares, they'll do it. They'll try to do it.
So I want to ask you about activism in other countries. So
Yes.
does it need some macro institutional environment for it to be effective?
That's right. So yeah, so I think there were attempts to go in Japan, in Korea, obviously in continental Europe. I think the ones that have been the most challenging, I don't know what Singapore, but you know, the ones that have been more challenging are Korea, I would say. So we've had, I think Elliott lose out when they engaged with Sony, I think? Samsung, right? So they lost with Samsung about a year ago, now they've engaged with them again. But in Korea, for sure, it's been very tough. I would say Japan is also, Japan is open. I think Abe is new, one of the heralds, right? There's much more openness to changes. So I think you're going to see more activism, for example, in Japan. I think third going to Japan recently in the final. So significantly less than the US, but I think you might see more of them in some of those countries where there is governance again is deemed important. But it's certainly less so than in the US. That it?